Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today is January 19th. We have Louis-Vincent Gabe and Ira Harris. Louis co-founded GaveCall in 1999 with his father, Charles, and Anatoly Kalitsky. Since 2005, he's focused mainly on money management side of the business. Before co-founding GaveCall, Louis worked for Paribas Capital Markets, where he was an equity research analyst from 1997 to 1999. He studied economics history and Chinese at Duke University and Nanjing University. Past decade, Louis has written several books, 5 books, including 2 Different for Comfort. Ira is an independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also a CME director from 1997 to 2003, and also a stint most recently there. Welcome, gentlemen.
Thank you, Richard. Good to be here.
Thanks, Richard. Good to see you, Ira.
Louis, it is really a breath of fresh air. I need to have some sanity, especially this terrible week of Davos, because it's my least favorite week when I have to listen to these.
Yeah.
Forget it. I'll hold my tongue because I was raised better.
Yeah, this is a family podcast. We can't start swearing right off the bat.
Okay. Okay. Great. I thought we begin, Louis, with your global macro view on the economy and the financial markets, and also what are your investment themes that you see for this year, 2023?
Dude, I can go on for an hour on this.
Okay. Okay.
Put a coin in that machine. You're gonna have to interrupt me. Okay. But look, my starting point is a pretty simple one. And it's the fact that the single most important macro development of the past few months is China's reopening. Now, to some extent, reopening economies are at this point like a James Bond movie. You pretty much know the script. You've seen it time and time again. It's just the decor that changes. And we've seen the movie in the US, we've seen the movie in Europe, we've seen the movie in Brazil, in Australia, in Canada. And now it's unleashing in China. And, the script, like I said, is always the same. You get massive pent-up demand and a big boost in consumption. Then you get some supply chain dislocations as everybody gets sick and, calls in sick. You remember when the US opened, it was the summer of the canceled flights, right? As every pilot would call in sick. It was the summer where you had 100 ships sitting outside LA because you didn't have dockers and you didn't have truck drivers. And, I think for the next few weeks, you're going to see the same thing in China. Now, arguably, the timing in China is pretty good because everybody's getting sick and calling in sick at the same time as you have Chinese New Year holidays anyway. If you remember, China always locks down for a week or two right around this time of year anyway, as everybody travels and goes home. So you have the supply chain dislocations, and on the other side of the supply chain dislocations, what you've seen in economy after economy is every businessman decides, every entrepreneur, CEO decides, well, if I need 100 guys to work my factory line, I better hire 120 to make sure that at least I have 100. And so everybody goes out and overhires, and then you get obviously higher wages, and that feeds into the inflation spiral that was already triggered by the supply chain dislocations. So, here we are. It's a movie we've seen before. The Chinese economy is, either the second or single most important economy in the world, depending on, what you're talking about. Talking about supply chains, it's definitely the most important. If you're talking about consumption, it's the second biggest after the US. And, to my surprise, everybody's sitting around wondering, are we going to have a recession around the world? How much is inflation going to collapse? Well, the reality is we have the second largest economy in the world that is about to reaccelerate big time. Now, in my career in for the past 25 years, each reacceleration in global growth was triggered by a reacceleration in China. Because once China reaccelerates, it leads to stronger growth in emerging markets, stronger growth in Europe, stronger growth in Japan, and eventually stronger growth in the US. And here, this was the case in 2003 when China was the 12th largest economy in the world. It was the case in 2009 when China was the 3rd largest economy in the world. It was the case in 2015 when China was the 2nd largest economy in the world. And so here we are, sitting in front of a big reacceleration in the Chinese economy. This should be the only thing we're talking about. But to my surprise, it's not. I think most people instead are singularly focused on, what's happening in the US, what's happening to US monetary policy, what's happening to European monetary policy. For me, that's not the big story of 2023. For me, the big story is China's reopening and the impact it will have around the world.
Interesting. And your thoughts, Ira?
Well, you know what, Louis has been writing about this, and it makes you sit up and you have to take that into account. And then what comes with it? I mean, I go back to when Louis and I, back in May of, I think it was May, it was either May or June of 2020. And Louis was very bullish commodities as I was, because we saw China in a different light. And what we talked about quite a bit then was, of course, that maybe it was a little bit later than that, is that the Chinese renminbi was actually going in the opposite direction of what all the classic pundits predicted, which is, hey, the global economy is slowing down, commodity prices are falling, and the playbook was, well, the renminbi will weaken as they try to protect their export markets. But that was proven totally wrong, as the renminbi actually went the other way. And lo and behold, commodity prices stabilized and started to rally because the Chinese were stockpiling. So they went into 2021 and 22 with massive amounts of copper stockpiled, so much so that when Chinese manufacturers, when prices started to rise dramatically, they were auctioning off commodities out of their stockpiles. So they played it brilliantly, by the way. Now, and I know we did really well, because Louis and I agreed on Freeport, Glencore, Bunge. We had a litany of them, and we wound up, and I'm still have rump positions left of them and actually trying to rebuild them. So when I look at what Louis says, I think that's absolutely right. And we're seeing it because, again, what's happening here? The renminbi, even with looser Chinese monetary policy, the renminbi's been performing pretty well over the last 3 months, and it continues to hang in here, even as people have tried to explain why it's going a lot lower. And then, of course, the interesting thing, and I know Louis wrote about that, was the way that you want to talk about a pivot, Xi pivoting on the way that he dealt with COVID, right? I thought it was, and Louis's point, and I read it, I had to read it 3 times, by the way, because I went back, and he talks about how many times the Chinese authority actually cave in to popular dissent. And I said, well, that's, nobody writes about that. And that's a really telltale point. And we've just seen it. This was huge. Now, because I don't speak Mandarin and I struggle a lot with Chinese regs at times, so I'm looking for areas around China. So Australia, New Zealand, I don't know what the hell is going on now that she resigned or announced that she's not going to run. So basically resigning, but it makes me very bullish on Japan. And Louis was the first one to talk about this. In 2021, when he raised the issue, and it was conjecture, but the issue was that the yen was weakening as dramatically as it was because there were those in Asia who were trying to drive the Europeans, especially because the yen was weakening against the euro. We had that euro yen go up to 150 on the cross. Hold on. Yeah. I like to be more exact. Yeah. So back in even October of this year, we got up to 148. So the weak yen was playing into the hands of aiding Asia. And now everybody, is crying, but the yen has rallied 6, 7, 8% since the December 20th supposed pivot by Kuroda, but we'll see about that. They got caught wrong-footed this week, so it's a good week to talk about it. So I'm looking for Japan, and the word, and I presented to that Olaf Scholz talked about Zeitenwende, which I don't speak good German either, but I think a historical turning point, which he had for Germany. Then my son Tobias, who's a Japan specialist, called it Zeitenwende when Kishida talked about his 3 points on defense policy as a historic turning point. So all this, I think, bodes very well for Asia. Asia is now going to carve out more of their own positioning. And it makes me, for the first time in a long, long time, very bullish on Japan, especially Japan defense industries.
I'd like to pick up,
Yeah,
if I can,
go ahead.
on something Ira said, because I think it's important, and sometimes misinterpreted in the West. The fact that you had these demonstrations in China, and the regime quickly caved in. I think that the typical perception in the West is that China's run by communist dictators, because it is. It's a one-party state, and it's a regime that. It is a dictatorship. But, I think from there, we tend to envisage and picture this regime as some kind of, North Korean regime that doesn't listen to the people, which isn't exactly true. There's in this whole, from gray to black, there's a whole spectrum of colors. And the reality is the Chinese regime actually does spend a lot of time listening to people. Now, I highlight this because obviously they shifted COVID policy very quickly, and so much so that they actually ended up wrong-footing and pissing off most people. Because right now, if you are anti-lockdown, you're pissed off, right? Because you think we stayed locked down an extra 2 years than everybody else. This is ridiculous. These are 2 years of my life that I'll never get back, etc. So you've pissed off all of those people, and then you've also pissed off by reopening very quickly without making sure that hospitals were ready, without making sure that people had the right medicine, etc. You've also pissed off all the people that were very COVID cautious, all the people that were very worried about COVID. So you've managed to piss off, the Chinese government managed to piss off, in essence, both constituencies, the people who, like me, thought COVID was not that big a deal and we overreacted, and the people who thought we need lockdowns and masks everybody and force vaccines on everybody, etc. You managed to piss off both. I highlight this because the Chinese government is now in a situation where they need to change the topic. They need the conversation, the national conversation, to be about something else but COVID. And the best thing you can have to change the conversation is an economic boom. The best thing you can have is a stock market boom. And that's why right now they're basically pushing on every button and pressing on every lever to get things going again. They removed the red lines for the real estate developers. They're encouraging the banks to lend to property again. They've recapitalized the weaker local authorities so that these guys could go out and do infrastructure spending again. It's very clearly there's now a push so that the chatter on Weibo, the Chinese Twitter, or the chatter on WeChat, the Chinese WhatsApp, stops being about COVID and starts being about something else. Now, the reason this matters is, Chinese investors tend to be very momentum driven. Things go up, they buy more. They're like, retail investors are momentum driven everywhere, but in China, for cultural reasons, they're momentum driven on steroids. Now we've started a bull market, and typically bull markets in China end when the government comes in and crushes the bull market. Either in 2018 through tech regulations, before that real estate regulations, before that they raised margin requirements and raised interest rates. So things get going, and usually market gets excited for about 6 months, and then the government steps in and says, let's cool this thing down. here's the thing, you know that's not going to happen in the next 6 to 12 months. You know it because they actually need this bull market. They need a win. They need to make people happy. And so, as you look around the world today, where can you find a positive, a very undervalued market with positive momentum and a government and policymakers that are actually goosing up the market? It's to some extent, it's exactly the opposite of the US. And in the US, you have a market that's historically still decently expensive, with poor momentum and a central bank that is now actively trying to crush it. In China, you have 180-degree reversal. So it's like, do we need to fight this? Like, do we need to look a gift horse in the mouth? When you've got an undervalued market with positive momentum and a government that's pushing it up, it's like, okay, I'll go along for the ride. I'll bite, and that's how I feel.
Yeah, and one big question on some investors' minds would be the investability in China. Like, we had concerns based on the Russia experience, right? People that were in the Russia ETF or Russian equities, for whatever reason, one side or the other side, they're no longer able to invest, or the ETF was liquidated. So if we go into like Hong Kong ETF or go into Sinopec engineering, is that a risk?
That's the best part, right? Is for the past year, everybody ran around telling you China was uninvestable. Just like in 2021, everybody was running around telling you energy was uninvestable. Remember that? And that meant that in 2022, energy was by far the best performing sector, partly because nobody owns it. And when nobody owns it anymore, that means that there is no natural seller. Today, the only people left in the Chinese market are the retail investors. And now that you have positive momentum, they're not letting go. And so even on days where the overall market is down, like the overall global market is down, China does its own thing and is moving higher, simply because no foreign investors own it. So yes, to your point, everybody's worried, is China investable? Now, the reality is China's not Russia. It's not Russia on many different levels, but if you say China is uninvestable, deep down that means Apple is uninvestable. Apple does 25% of their sales in China. They do most of their stuff there. That means you say, if you think that we're going to have a similar outcome to what we have in Russia, that means Procter & Gamble, Ford, General Motors, Apple, all those businesses that do between a fifth and a third of their sales in China are, their share prices are going to get crushed because they're going to have to walk away from business. When the US businesses had to walk away from Russia, they were leaving crumbs on the table. It was a rounding error. The US every year exported as much to Russia as Belgium exports to Russia, just to put before this Ukraine war. Just to say, like, for the US, it was nothing to walk away from Russia. Walking away from China is simply not conceivable for a number of Chinese businesses, of US businesses. So to say, I'm not going to own China, but I'm going to own Apple, is a contradiction. You're running the exact same risk. If you think that tomorrow businesses are going to have to walk away from China, then you should definitely not own Apple. You shouldn't own half of the S&P 500. So it's not going to happen. It's not going to happen. And so the bottom line is the fact that everybody ran around in 2022 telling you China's uninvestable, just as they did energy in 2021, is one of the reasons China will be one of the big outperformers this year.
So, your thoughts, Ira? That's great insight.
So I two things jumped to mind because, of course, the Davos crowd is making a big deal about Liu He meeting with Janet Yellen. So I imagine that this fits exactly into that puzzle, because all of a sudden China needs to redirect itself from it's not Russia, and it has to remind everybody of that. So you get Liu He, and now Janet is going to China at some point. So yeah, that fits in there, I think, very, very well. But Is this also, in your estimation, because I think, I know the answer, I'm not throwing this out, that the emerging markets are now looking so well, especially on a relative basis to US equity markets. I mean, you want to see those markets that have most underperformed over the emerging market, but they're getting ready to ramp up. And is that also going to be carried by China?
I think it is. There's many different ways to play the China recovery. I understand that people might be uncomfortable owning Chinese equities. I think that's where you'll get the biggest bang for your buck, because they are the least owned, because they are very often the cheapest. But if you think, I don't want to own that, yeah, you can buy Indonesia, you can buy Japan, you can buy Korea, you can buy Europe. One of the big reasons, I think, if you look at Europe, who would have thought this time last year, as Russian tanks started to roll into Ukraine, and as if you had known that the Nord Stream pipelines would blow up, that Europe would be cut off from Russian gas, and all the things that we saw, that Europe would end up outperforming the US. Like, who would have made that bet, right? Very last year, very, very few people. Now, a lot of the European outperformance occurred basically in the last 2 months of 2022. And it was basically France outperforming, it was Italy, and it was all the China reopening plays, the LVMH, the autos, the tourism, the luxury goods. And so all this to say, lots of ways to play the China rebound. Absolutely. Right now you're seeing copper rally like crazy, right? And incidentally, and not just copper, aluminum, iron ore, tin, nickel, you name it, all the metals, for a very simple reason. Now that China's property developers have access to capital again, they're going to finish all the projects that were mothballed. And so all of a sudden, the demand for metals is going to go up at a time when global inventories are actually very, very low. This is all unfolding in front of our eyes. By the way, on this, everybody always talks about Dr. Copper, right? The metal with the PhD. And it's interesting because people always bring up Dr. Copper when the metal is falling. Like, they look at the falling copper, they say, oh, look, copper's falling, the sky's falling, we're heading to a global recession, etc. People were saying that 3 months ago. Copper was falling. It's like, oh, look, Dr. Copper. Dr. Copper is now heading for the moon. It's rallying like crazy. Yeah. And nobody's talking about Dr. Copper. It's like all of a sudden he lost his PhD. He has at best a B.
Yeah.
Maybe he didn't even graduate high school. Nobody talks about it anymore. But yeah, I think there's how can we think there's a global recession about to unfold and a collapse in inflation sets around the corner when you have metal prices rallying, and when you have the world's second largest economy that's rebounding very, very strongly, and as it rebounds, bringing along the Indonesias, the Australias, the Japans, and the Europe of this world.
And do you see? Yeah, go ahead.
Yeah. So we've had this discussion in other podcasts. Richard hosted Dr. Faber a couple weeks ago, and Eichengren last week, Professor Eichengren. We've had this conversation about, if you think that the United States and China, look at Germany and China. Germany and China is so, and I have a very good friend, Kevin McCarthy, not Kevin McCarthy in Congress, but Kevin McCarthy of Integrity. And we've talked about this, that can Germany make it without China? And if that's the case, Europe becomes much more interesting, because Germany has to protect its relationship with China. It has really nowhere to go on this short of notice. And so many German corporations are so tied in there, as you talked about, and on the conjecture on the weakening of the yen and what was some of that purpose. And that made it far easier for the Japanese to displace German manufacturing, because let's face it, nobody competes more directly in the world than Japan versus Germany. Heavily export high-tech products. So
that's absolutely. I would say you're absolutely right, Ira. And the Americans 8 months ago, were putting pressure on the Europeans to say, hey, look, join us in our anti-China crusade, and let's block China on everything. And in essence, the European response was, look, we've already lost Russia. It was a big market for us. It was a peanut market for you, but it's a big market for us. Now you're asking us to lose our single biggest market? Are you nuts? Like, we can't walk away from our two biggest markets in a year. And for what? What has China done? Like, what's China's big crime? Sure, we don't like the regime. We don't like communist dictatorship like the rest of them. But fundamentally, it's we're not going to cut our nose to spite our faces over here. And you saw this very clearly when Olaf Scholz went to China. He went off to China this summer and basically said, look, China is very important for Europe, and we're going to keep doing business here, etc. And since then, I think the U.S. has sort of tweaked its position. You had a good meeting between Biden and Xi Jinping at the G20. As you mentioned, you just had a good one between Janet Yellen and Juha at Davos. It's the whole anti-China rhetoric has shifted dramatically. And I think one of the reasons it's shifted, it's partly the result of the U.S. elections in November. I think in the U.S. being anti-China is sort of the only thing American politicians agree on. They don't agree on motherhood anymore. They don't agree on apple pie. But the one thing they'll agree on is being anti-China. And what happened was the Democrats did a lot better than expected, right? They kept the Senate. They did better in the House. And so now all of a sudden, if you're Joe Biden, you're sort of forced to have another good 2 years economically, right? You can't afford to have a really crappy 2 years and blame it on the GOP Senate and blame it on the GOP House. You need good results. And the reality is you can't have good results. You can't get inflation in check. You can't have decent economic growth if you're having economic warfare with China. I mean, that's this, like, if you have economic warfare in China, prices at Walmart go up 20%. That's the simple reality. And you have prices in Walmart that go up 20%, the Democrats get smoked next time around. So if you're Joe Biden, you're sort of, by the very force of the electoral calendar, you're forced to make sure that, things are not too bad with China.
And further to that, do you see China aligning more with industrial and engineering companies in Europe and in Japan versus American industrial and engineering firms?
So I think that's a great point. For the past 5-6 years, I would say that every Chinese company has tried to de-Americanize their supply chain. Basically, when the US government said, okay, nobody's allowed to sell semiconductors to Huawei, within every Chinese company, the message was, I don't want to be the next Huawei. So I got to look at my own supply chain and see what I depend on the US for, and whether I can get that instead from Germany or Japan or somebody else. Take airplanes. That's the most obvious example, right? Is if you're China Eastern Airlines, and you see the sanctions that have been put on Russia, and you see the sanctions that have been put on Huawei, you think, okay, do I buy Boeings or do I buy Airbus? If tomorrow there's more tensions between the US and China, maybe the US government decides no more Boeing spare parts to China. And then if you're China Eastern Airlines, you got a bunch of really, really big paperweights. So you're going to go with Airbus now rather than Boeing. If it takes, in any car, you usually have between $2,500 and $3,500 worth of chemical products. And some American companies are right at the forefront and very productive at producing these chemical products, partly thanks to the U.S. comparative advantage on energy costs. So, your Dow Chemicals, your DuPonts, et cetera. But if you're BYD now and you think, okay, I spend $3,000 a car in chemical products, are you going to buy them at DuPont or Dow, or do you think maybe I pay up a little more and buy them at BASF to be on the safe side, right? To make sure that tomorrow, if the U.S. government says no more chemical products to China, my whole supply chain doesn't implode. So I think because of that, because most Chinese corporates have spent the past few years de-Americanizing their supply chain, as China reaccelerates, it's Japan, Korea, Europe are going to benefit a lot more than the US.
Hmm. Your thoughts, Ira? I know you're big on like
Yeah,
work from
I see
ABB or Siemens. Yep.
the world so much, and as I look at you, and as I read through the Kishida's three major points on defense changes, then I said, first of all, people, because guys like Jim Cramer and others, well, this will be great for U.S. defense stocks. I don't see that whatsoever. I see Japan, who has the ability with a flick of a switch, so to speak, to be able to ramp up their high quality defense production pretty easily, and that they won't, they'll buy what they immediately, maybe cruise missiles and things from the US initially, but they certainly have the technological expertise and the manufacturing capability to compete directly. And once they go down that road, you have less leverage over them. Yes, the US nuclear umbrella will protect Japan, but other aspects of it change dramatically. And so where Reagan could squeeze the Japanese in the 80s with James Baker, that's going to change. And the Japanese will be able to do things on their own and make decisions on their own, rather than always being almost kowtowing, to use an appropriate phrase, to the US demands. That's going to change. And you're going to unleash, between Germany and Japan, now you're going to unleash competitors, as Louis talks about. Airbus has always been a Boeing competitor, and they're going to have more at stake. And I think that's a really good thing to look at, because we know when the United States goes down the sanctions path, that's what they do. That's what they initially, that was the experiment in Cuba. We just cut off everything. So they were forced to rely on the Soviet Union, which was pure garbage. And then they kept all those cars going in the best, and they became the most creative mechanics in the world in order to do that. People do adjust. And it leads me, Japan has been so dormant, and we're going to get into this. It's been dormant. Look at the highs in the Nikkei were made in 1989. We have not gotten close. To me, if and I talked about this with Dr. Faber, he disagreed with us, but I look at Mitsubishi Tokyo as one of the greatest investment possibilities in the world if this all takes place in the way that we're talking about it. Because there's a financial, that was what everybody wanted to mimic, was Tokyo Mitsubishi is a great financial supermarket of the world. It didn't work for a lot of people. We ran into 2008, of course, but Tokyo Mitsubishi, it's about time they start paying out more dividends, by the way. But if all this starts to take place, they will become a huge funding platform for Asia. And I think Asia is the story that we've all been waiting for the next time. It's been a great story anyway, but it's on to the next leg of it. So I'm looking for those. So I think Louis is right. And that can even be done. To me, the yen at 145 was just ridiculous. And I think last time Louis and I talked about it. It was ridiculously weak, and how the world was letting the Japanese, but that can bled into the bond market, right? And I hope we go to the bond markets from there.
Well, so, just to follow up on what Ara has been saying, I think when you look at the Japanese market, you have a deeply undervalued market and a deeply undervalued currency. And the old story, you don't break a leg falling out of the ground floor window. It's in Japan, you're buying it on the ground floor. Now, the question is, of course, what will be the catalyst to move things higher? Because things can be cheap and stay cheap for a very long time, right? So what will be the catalyst? And I think today we're seeing a number of catalysts emerge for Japan. The first one we've talked about is China reopening, and China and Japan are each other's biggest trading partners. And Japan benefits from China's reopening on many fronts. Of course, the industrial side of it. I've been, and I've even wrote a book that you mentioned, Too Different for Comfort, on robotics. I've been a big proponent of robotics. I even helped launch a robotics ETF in the US called Robo. So it's been sort of a passion of mine. And what was interesting to me in the latest batch of robotics earnings releases from Fanuc, Cayenne, Sekagawa, all those guys, was how they had super strong numbers. They absolutely crushed their numbers. And it was mostly because of orders from China, all of which makes sense. You got a cheap yen, you got a tight labor market in China. It all feeds into one thing. So you've got that as a potential catalyst. Better earnings, better growth, boosted in part by the weak currency. So that's one thing. But I think the other catalyst that's increasingly unfolding and which we're seeing is as Japanese yields creep higher or surge higher, you're seeing a lot of capital repatriation. You're seeing the Japan has a net foreign investor position that dwarfs anybody else's. They own so much capital abroad, and so what ends up happening very often in Japan is as the yen goes up and as asset prices domestically go up, it encourages, if you're sitting in US treasuries or in Brazilian bonds or whatever else, and you're Japanese, you think, oh, you know what, sell my US treasuries, buy the local markets. And I think this is also starting to happen and could move quite a lot in 2023, which incidentally, I know Ira is keen to talk about this, has an impact on global bond markets. Because the Japanese savers, whether through the banks, through the insurance companies directly, have been huge buyers of foreign bonds, partly because of the positive carry they get from owning US treasuries or whatever else. As that carry shrinks, and you are seeing it shrink today, do the Japanese institutions and private savers stay invested in European bonds? Do they stay invested in US treasuries? I think we're seeing that the answer is no. Where as we're talking, they're selling every day, repatriating capital. But it begs the question: who's going to take their place? If your Japanese institutions sell U.S. treasuries, the question is to whom? Who's going to step up and buy these things?
I'm glad we're getting to that, Richard, because this was the classic, and there's so many algorithms still working off of this. What was the risk on, risk off correlation of the great financial crisis, right? So when risk was going off, people were buying yen. So we had in 2011, 2012, the dollar yen was still hanging around at 78 to 82 to the dollar because there was a lot of repatriation of money as risk off. Every time there was a risk off event, the yen would go higher. Now, this risk, as you rightly point out, this is a different thing. The Japanese have more money invested around the world. I think it's like $3.5 trillion, which is an enormous amount of money, because they've not been able to generate any returns, of course, at home for 2 decades, 25 years. So they've had it invested and smartly in a lot of industries. But now, as you point out, when the money comes home, it's not a risk off. That's not why it's doing this. So we're every time the yen rallies, the Nikkei gets hit. And we've seen it, although that correlation started to break down a little bit, which says for your purposes that, hey, if the yen goes back to 100, and I'm not saying that it's going there, but if it does, and the Nikkei keeps rallying, all these models, these correlative models are going to get killed because the action is going to be that Japanese corporations for years have been working, as far as I understand, at 105 yen to the dollar anyway. So when you're at 135, 140, there's not, it's plenty obvious. I know in the third quarter, Japanese corporations had phenomenal CapEx, I think 9.5% CapEx spending for the quarter. And they were sitting on huge profits. Of course, they're sitting on huge profits. And yet, everybody talks about, the weaker yen should make the Nikkei. Well, last year, the Nikkei was down 11% and the yen was down 11%. So those who establish that false correlation, I think, are going to get their brains beat in. I can't tell you when. I wish I knew, because I would then play it in the options rather than trying to finesse it other ways. But I think that risk on, risk off model is dead if the Asian story bears out. I think it's going to be a whole different viewpoint, and it does. And let's get into the bond market. Now, I look at the global bond market, and I'm truly perplexed. And I've read what you read, and I've listened, because I go, people say, well, what should I do? I said, I can't tell you who's buying a US Treasury at 3.5%, a 10-year Treasury at 3.5%. By what measure? What do you think about? So the old model says, well, that's indicative that we're going into this recession. I don't care whether we're going into recession. If you go into recession and the Fed does nothing, if the Fed stays at 4.25 to 4.5, if it stays at this range and just pauses, and I know you've talked about this, you threw out the number of 1.3 trillion of the cost of financing the US deficit, I believe. I'm not,
Yep.
I believe you said that, so that's where I want to go. But that makes us, you're in a debt trap. And this is the real story of the US in the 70s. You know, and I tongue-in-cheek say this. Yeah, Powell talks about finding his inner Volcker. Paul Volcker couldn't have found his inner Volcker with 110% debt to GDP ratio, right?
That's right.
So that brings us to the bond market.
No, look, I couldn't agree more. I like you, I'm perplexed. You know, 3 months ago, US bond yields were 3.5%. In the meantime, we've had all the metals rally 20-25%. We've had China reopen, and we've had the ECB turn more hawkish. We've had the BOJ slowly but surely start to give up on yield curve controls. And US bond yields are still 3.5%. It's almost, you wonder, you know, you indeed wonder who is the buyer. Now, the reality, I think, is, you know, you and I were having this conversation. It feels sort of deja vu all over again, because we were having this conversation 2 years ago when bond yields were 1.5%, and we were saying, what the hell are people thinking? You know, who's buying these bonds with bond yields at 1.5%? And then all of a sudden it changes. It's the Mark Twain story. How'd you go bust? Slowly and then suddenly. It's like nothing. And this is how markets often are, right? It's like nothing happens, and you scratch your head and you think, what the hell is going on? What am I missing here? But then all of a sudden it happens. And when it happens, as we saw with the bond market last year, it can happen very, very quickly. So, you know, you've got your 3.5% yield today, and then all of a sudden you get 1 or 2 bad inflation prints in the US, 1 or 2, you know, decent growth prints in the US, and you wake up and you're at 475, you know, and it can happen, as we saw in 2022, it can happen in a month. Now, the only explanation I can come up with as to why you're still at 3.5, I don't know if you've been following this, Ira, but the BLS is changing the way they're calculating inflation. They're basically pulling an Argentina on us. Do you remember when, you know, Argentina, when, you know, that the GDP got over 100% and they needed to tighten, but they couldn't. They just changed the way they calculated inflation to say, oh, by the way, inflation isn't at 10, it's at 5. So, you know, don't look over here, look over there. Everything is good. And the US is doing precisely that. Starting next month, they're changing, the BLS is changing the way they're calculating the CPI. And the new methodology, which focuses basically, I don't want to get too technical, but it basically focuses much more on year-on-year comparisons, which means you get a much bigger base effect. That will probably mean that inflation mathematically comes down by 200 basis points, sort of magically. So I think the US is, in essence, pulling in Argentina. And of course, it doesn't mean the prices that you pay at the store will magically be coming down. But it's the data. And as we know, so much money now is managed by algorithms, by computers, that, you know, maybe people are anticipating, because of this change, you're going to get downside inflation surprise, and this is going to drive a bid for bonds. And but deep down, you know, you can fool some people some of the time, but you can't fool all the people all the time, right? Deep down, you'll be left with still a higher structural growth rate of inflation. Now, the Fed will tell you, oh, it's okay, inflation's at 3. The reality is, the underlying reality is it'll be at 5 or 6. And here, I think, I'm a firm believer in what Jacques Rueff, the French economist, used to say, that when push comes to shove, the most of the adjustments are borne by the exchange rate. That the foreign exchange are sort of the gutter in which all the excess stuff ends up washing out, and so I think this adjustment by the Fed, the U.S. dollar will end up paying the price, but perhaps it allows the bond market to stay on course a little longer. That's the only thing I come up with to explain today's 3.5. Otherwise, it doesn't make sense to me.
Yeah, I think that's, bringing up Jacques Rueff, The Monetary Sin of the West, which I have 2 copies in case somebody breaks in my house and steals one. I'll always have another copy.
To what extent could the Japanese repatriation be affected by Bank of Japan monetary policy in terms of like yield curve control? Are they going to give up on that, widen the range? Any thoughts there?
Yeah, I think Japan's an interesting one here because I think what's happening right now is Kuroda's leaving in April. And usually by now you'd have a successor and he'd be going through the Diet, which is their parliament. And just like when you appoint a Fed chairman, you go for your hearing and you get questions from parliamentarians in the US. The same thing. We should be going through that process right around now in Japan, and it's not happening. The rumor on the street is that the main guy who's thought for it is sort of holding back on the premise that I'll come into the job if some kind of normalization has already occurred. I.e., I don't want to be the guy coming in and having to completely upend monetary policy and basically Kuroda made the mess, so now Kuroda gets to clean it up. Is sort of or at least clean some of it up. Now, against that, of course, just like you're going to have in the U.S., you have the challenge of a government, like a government debt. Ira mentioned 110%, 120% of GDP. How much of an interest rate hike can you have, and can the government sustain? Now, Japan is in a better position on that front than the U.S. because Japan's actually extended a lot of the duration of the debt. So if you look at the term structure of the Japanese debt, it's actually quite long. So raising rates isn't going to hurt immediately. This is where I think that the U.S., perhaps out of hubris, I don't know, made a big mistake, is in the years where you had 0 interest rates, the U.S., instead of saying, oh, you like this 30-year debt at 1.5%, here's a bunch, take it. Instead of doing that, which is also what the Europeans did. Remember, Austria did a 100-year bond that's now trading at like 20 cents on the dollar. That was a genius by the Austrian government. Italy did a 50-year bond. France and Britain did a bunch of 30-year bonds. The U.S. actually, during this period, shortened the duration of the debt. So much so that in the next 2 years, you have something like half of U.S. debt that needs to roll over. I mean, it's absolutely nuts. And it's going to roll over at much higher interest rates. And so but anyway, so back to Japan, I think we're now in a phase where between now and April, Kuroda needs to sort of normalize monetary policy. And you're seeing it, you're seeing the JGB yields break out. You're seeing the steepening of the yield curve. All of which, as Ira pointed out, is good news for the financials. You're getting capital repatriation. Things are, sort of coming back more or less to normal in Japan. And yes, I think that has a dramatic impact on global bond markets.
Great point. Yeah. And thoughts here, Ira?
Louis, I'm so glad because I'm sitting here with the Bloomberg latest sheet in front of me, and the Japanese curve is steepening. But 18 months ago, we would sit here and talk about how many global bonds, sovereign debt, were negative, were nominally negative. Now that's, of course, everybody, there's no more 0, big friggin' deal. But I will tell you something that is interesting, is that 11 out of the 23 curves that appear on my sheet are now inverted. And what ought not to be happening in that is gold ought not to be rallying. But yet, while these curves globally, we have the German curve inverted, we have, well, the Canada is actually less inverted. They were the most inverted, but they're actually lower than the US. How the US curve stays inverted here, again, I scratch my head at. And even the fact that it's the most inverted, because again, why would you buy a 10-year note when I can buy a 2-year and give myself some flexibility? Or I can buy a T-bill of 1 year. I have flexibility, no capital risk. Who is advising these people? What's wrong? You didn't lose enough capital last year if you had to sell your bonds. Who is making these decisions? But lo and behold, there's the Japanese curve, which outside of Italy and Greece is the most steep of all. That's mind-boggling. Now, is that a good thing or bad? For asset prices, I'd make that a good thing, because that historically has been the case. Again, another thing pointing to Japan, and I think they have extended duration. And also the Japanese have, what is it? The Bank of Japan probably owns 65% of the outstanding. I mean, so they are in a much more flexible position. Everybody can, well, it's 250%. Yeah, but it's 250% financeable. The United States, as you've talked about, it's 110%. And your cost of financing that is going up dramatically. So, people said 500 billion will be the cost of interest. I don't know where they're coming up with that. I see closer to 800 this year when I do the math, and that's a huge difference. And in the United States, that bears great political ramifications, because you are now going to have to make decisions about discretionary budgetary items. And that's when the politics in the United States really gets ferocious.
Yeah, agreed. Agreed on all. And look, the big difference between debt in Japan to say debt in the US or debt in France, my own country, is something like 94% of the Japanese debt is owned by the Japanese. So they owe the money to themselves. So as I always put it, if I borrow $1 million from my dad, as a family, we don't have any debt, right? I mean, if you net it out and you aggregate it. So, and the Japanese really do think of their nation as one big family. In the US, to your point, saying like 40% of the debt is owned by foreigners, and even so, and even within the US, there isn't that feeling of, or France for that matter, my own country, roughly the same numbers. There isn't that feeling of we're all in this together. If we need to do hardship, we'll take the hit on the chin and we'll carry this out. So it's, as we enter, a higher cost of debt, some tough political choices are going to be made, and yes, to your point, they're going to have to be made in societies that are extremely, extremely divided. In a way that, Japan isn't extremely divided. China isn't extremely divided. South Korea isn't extremely divided. There isn't animosity of part of the population against another part of the population. You don't have any of that. And even the local politics aren't meant, what's worrying about politics in the West to me, and here we're veering a bit off topic of markets, but is increasingly how politicians see their jobs as aggregating different minorities. Instead of talking about what brings us together, it's, I'm going to go for this group and this group and this group. And if I manage to add up these three groups, then that's a majority and I win power. And you see this, increasingly more and more. And it's very disturbing, because it puts you into a tough bind once real problems show up.
Good points.
Yeah. I can't, and that is on the horizon unless some real leadership comes to deal with this, but.
Yeah. Just a final question on, given the opening of China, what are your thoughts on the emerging markets in Brazil, Argentina, Colombia, in terms of investing there?
Look, again, we're all the fruits of our own experiences, right? In my career, when China's reaccelerated, emerging markets have done well, and especially the ones that are tied into the commodity cycle, like the Brazils, like the Colombias, like the Chiles. And so, this time around, so you have China reaccelerating now. Why would we expect it to be different, right? So if we think, okay, logically they should do great. So why shouldn't they? You think to work in markets, you have to be a bit schizophrenic, right? You build your scenario and then you try to undermine it. Like, okay, what could I be missing? Where could I be wrong? So what's different this time from previous cycles? So yeah, so one difference is everything we talked about Japan, and historically, Japanese investors have loved Brazilian bonds. So perhaps as Japan sort of changes monetary policy, do the Japanese sell Brazilian bonds and bring capital back? If that happens and it leads to a sell-off in Brazilian bonds, I would say that's a terrific buying opportunity on Brazilian bonds. I would be inclined to buy Brazilian bonds on such an outcome. So that's potentially one thing. Another thing where I think, okay, where could I be going? And to be clear, I am bullish on these countries. Right? To be very clear, I think they do well. But if you want to be devil's advocates and say, okay, what could happen if it goes badly? The second thing that could go badly is that this time around the boom in China, and especially in real estate and infrastructure, is more muted than historically. Now, I think actually this is very possible, but that's probably more a story for 2024. In 2023, for now, we're finishing projects that have been mothballed, et cetera. So, on this front, I think. And then you have the sort of elephant in the room, which is the blow up of the Nord Stream pipelines. And here, I joke in interviews, et cetera, that nobody's looking at the obvious culprit for the blow up of the Nord Stream pipelines, which is China. And of course, I'm kidding. I don't think China blew up the Nord Stream pipelines. But when you look at who benefits the most, if you go through when there's a crime, when the rich uncle dies, the first thing you look at is when the rich uncle gets murdered, the first thing you look at is who's the first inheritor, right? Who benefits the most from the blow up of the Nord Stream pipeline? It's China, because Russia, who was always facing west and had all of its infrastructure facing west to feed its commodities into Europe, now all of a sudden realizes I have no choice but to face east, and I have to crank up all my infrastructure and move everything towards the east, and towards China. That basically becomes the main and sole buyer of Russian commodities. So I highlight this because that's perhaps a long-term threat to Brazil, to Chile, to Colombia. If your business was, I'm going to sell to China, and China says, I'm good, I got everything I need from Russia, and I get it at a discount, then perhaps that's not great. Again, I don't think that's a story for 2023 because you need to build that infrastructure and it takes time. But just more sort of structurally long term, that's something to think about.
That's interesting, great points. And your thoughts, Ira, or any other topic or issue that you want?
I mean, I certainly agree with all that. And when I did the one, I think Lula, who proved to be really positive for global capital, because he shows what you can do if you actually think about things and try to do them in a much more pragmatic way. And I think Lula is nothing but pragmatic, by the way. I think he gets a bad rap from global capital because they just get locked into a binary viewpoint of the world. And it's, AMLO in Mexico, I think the Mexican peso has done great. I mean, it has defied everything, but I think Augustin Carson really laid that out as to why they got ahead of what they saw was coming. They were much more aware of the inflation bogey and did get ahead of it because they knew they had to protect their currencies somewhat against, because they were their dollar liabilities are so big, which the Fed, I think, fails always to understand because it's, again, not in their model. And they need to, of course, that model has been so flawed for so long. But I think these are all really good points. And the one that I hope we come back to on another one is what's going to happen with the European debt markets. because European debt markets play into this too and make the bond markets around the globe that much more. And Christine Lagarde is terrified of a fragmentation. Right now, they're not fragmenting, they're going the other way, so she feels pretty good about it. But that's a story long in the making. We saw what the ECB was very reticent about beginning quantitative tightening because of that. So they pushed it off, and it's 15 billion starting in March, which, it was laughable. But, I go back to what Klaus Knott talked about in the FT 2 weeks ago, when he said, coming out of, after the ECB meeting, that more than a third of the members wanted 75 basis points. Because all that the ECB has, they really can't do anything with the bond markets because of the fear of fragmentation. So all that Christine Lagarde can really do is to be more aggressive on raising short-term rates and see where that's going to take them. But the double shotgun approach, as Druckenmiller would call it, that's not going to work. And we're going to have a lot of work to see what happens in these bond markets. And again, I look at, really, you're buying Italian 10 years at 3.78. You're buying, who is buying these? In what mindset? First of all, because you're paying valuations that have been so distorted for so long. How do you even know what anything is worth? We don't have that. It frightens me, the global bond markets, because as Louis says, you're going to wake up one day and go, what? I've been doing what? I've been paying what? Oh, everybody told me bonds were going to rally this year because we're going into a recession. But in a debt-trapped world, when you go into a recession, the cost of financing that becomes a heavier burden, not a less burden, and you have falling revenues on top of it. So you're gonna wind up two ends on the short straw, and that deficit is going to grow and grow and grow. And I wish Biden, somebody should tell him, stop talking about how you're cutting the debt, how you're cutting the deficit. Oh, because it's the law of large numbers. Yeah, you can't sustain $2.5 trillion in deficit spending forever. So yeah, of course, everybody needs to take a step back and think. But I think this is something that plagues and may well be, because something is bothering the gold here. Gold ought not to be rallying into everything that we've heard, right? And it started really, and I would say November 2nd, during the Fed press conference, when everybody interpreted the Fed's statement as somewhat dovish, and Powell couldn't wait to get to that press conference and put an end to that. So it told me there was probably more dissension in that meeting than the vote reflected. But by the end of the week, gold closed higher on the week, the dollar closed lower. And from that week on, we've been in a different paradigm as far as a lot of asset classes. But I love these talks with Louis. Thank you for taking the time, Louis. Richard, thank you for hosting. This is phenomenal. I could do one of this. Oh, I promised somebody, because Asia is the story. And you and I talked about this. I'm so bullish UBS. It's hard to be bullish a Swiss bank, but somebody went back to doing, as I say, they're knitting, and they're doing huge. I think their huge wealth management presence in Asia is so big that it plays well for them. Do you have a view on that? I promised I would.
Yes, I do have a view, and you're absolutely right that historically, UBS is a key private bank in Asia. I wonder though if on this on the idea that you always have to look at what could be different in this cycle. The fact that all the Russian oligarchs' accounts were frozen in Switzerland in a year ago. If you're a rich Chinese, do you still feel as safe in a Swiss bank as you did 18 months ago? 18 months ago, the view was nothing is safer than a Swiss bank. And now, all of a sudden, if your leader's a jerk, they can take your money, which is what just happened. So now I think if you're Chinese, you're probably more inclined, if you're a rich Chinese guy, you're probably more inclined to go to a DBS bank in Singapore. Or to a UOB bank in Singapore, or even a bank in Dubai. So then you are a Swiss bank. So I think if you want to play that, you're probably better off. You're instead of owning UBS, you should own DBS. You're just one letter off.
Which one? I'm sorry.
DBS. It's the biggest bank in Singapore.
You know what? Yeah, I know it. And that's what Faber talked about, rather than buying.
Asian Bank. Yeah.
So you're probably better off owning DBS than UBS.
Okay. I see it. Or the best wealth manager in Asia is GavCal. So you probably want to give your money to
Yeah. There you go.
Yeah. How can our listeners, viewers learn more about your work, Louis, like and the research at GavCal?
Yeah, no, absolutely. Well, first, thanks for having me. Always a pleasure to catch up with both you and Ira. So the easiest is to go to our website, gavekal.com, GAVEKAL.com. The most of the research we publish is institutional, though. We do have a private wealth arm in the US that reproduces some of our research for free. So that's Evergreen GavCal. So people who want free research can go onto that. And yeah, but I don't really spend much time on social media because I don't have the time. So the best way to keep abreast with what we do is through those two websites, Evergreen GavCal and GavCal.
Great. And Ira, you got.
It's the same as always. And I will tell you, all the appearances you made in December were greatly received by people who are really not knowledgeable, and yet who are fairly wealthy, but they don't have any knowledge, and they loved reading. I mean, I've gotten a mailbox full of responses to it because I sent out the transcript one that Richard had sent me, and a lot of people read that and said, "Wow, this is what I need to see," because banks don't give you that. So I will tell you, very well received. And Richard, I'm not writing that much. I'm going to start writing more. It's just been,
Okay.
It's always the same stuff, but we watch, and I love doing these. So thank you for hosting them.
Great. Thank you so much, Louis and Ira. Thank you.
Louis, thank you very much. Be well.
Have a great day, guys.
Thank you.
Yep. Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.